You are now locked in and you're learning with Vel. Now, if you're trading my Learn with Vel strategy and it's not working for you, there is a reason why, guys. Everything that you're doing right now can be fixed. So take a breath, sit back, relax, and let me help you. Okay, so the most common problem I hear about when people are trying to trade the LWV strategy is that they're jumping into too many unsuccessful trades. Now, essentially, guys, trading is a game of the dice in a sense where you're accumulating as much as historical data as possible to put you in a position of being on the favorable end of the profitability scale. Okay, this is a game of profitability and it's a game of also predictability. We're predicting that price will do things that we've seen it do before and also based off of price action. Okay, that is a key important word here, price action. Now, the key thing you guys could learn from today's segment is that price is not as important as time. Okay, time is more important than price, guys. Time is more important than price. Some of you are marking out session candles and you're probably expecting price to react as soon as it plays into it, but you're nowhere near the time that price should most likely react or price should have an increased amount of volume with that particular pair. So, for instance, we're on GBP USD. Now I'm just going to keep going back randomly. I'm going to zoom like this and I'm going to keep going back as far as I can. Randomly going to stop here. Okay. So now we stopped here, we're going to find price. Okay, perfect. Now we've found some price. We're going to start up here. Okay, we're going to start at the top. Now, this may go right, this may go wrong, but hopefully it goes wrong so you guys can see that, you know, having trades that don't work in your favor can also count for you guys leading up to having a more profitable trade in the future. Now, essentially, the first thing you guys need to make sure you're doing, okay, this is the only game that if you make a mistake, you can get punished financially straight away. So it's really important to pay attention to the detail. Now, for a bearish candle, the close of a bearish candle is at the bottom. Okay, so that means we're going to measure from the close, not from the low of the wick. We're going to measure from the close of the bearish candle. Okay, and we're going to now measure downwards because we can see price moves down, it goes up a bit, but ultimately we see price comes down, right? And it comes down more than 40 pips, guys. 40 pips is the number you guys need to remember. Price needs to come down more than 40 pips, okay? If price can come down more than 40 pips, what is that going to do? That is going to trigger your interest to say, hey, price has moved more than the average. Let's have a look to see if price can continue going in that direction after we get a pullback. Okay, so in this case, price pulls back, and of course, you know, this trade does look quite profitable because we can see here price does not go up more than 35 pips, gives you maybe around a 10 to 15, maybe 18 pip drawdown, and then price comes down, right? Price comes down, you get your 3 to 1 quite easy. Price continues to come even down lower, and you get a 6 to 1 R&R. Some of you might be saying, well, this is a, you know, this is a trade in the past. I mean, have a look at this. If you catch that trade from the top, guys, wow. Okay, you get probably a 10 to 1, if not more. Okay, probably a 10 to 1, if not more. Now, the problem that you're probably facing when it comes to identifying these trades, guys, is you're not taking into consideration the bias of the market. If the market is bullish, right, then I know that the buys are probably going to be more profitable and more long-term than the sells, okay? Ultimately, this chart was bullish, okay? But we know, and if you don't know, you should know, when price stops making a higher high, okay, that's usually an indication that the market direction is about to change. So based off of that, what we can understand here is, look, price pushed up, it came down, and then it failed to go higher to make a new higher high, which now meant this higher low is not a higher low, because it didn't make a new higher high. This is just a low. So price has come down, it's pushed up to make a lower high, it's come down to make a lower low. By the time you've seen that happen, guys, this game is about patience. When you mark out your session candle, it may take hours, it may take days before price comes back into your area. In this case, this was let's zoom in and make sure we got this correct. Okay, yeah. So in this case, where's the 1 p.m. candle? This was the wrong candle I marked. Okay, so this is the candle here. Okay, let's put on the magnetic tool. All right, cool. Okay, in this case, that is the candle. Okay, it doesn't matter how big or how small the session candle is. All we care about is the session candle. Okay, price has come down. So we know that when price comes back up, we're going to take two entries. One off the foot of the candle, which you can see price just about taps us out. And this is the reason why we take trades at the 50% as well, guys. You have to take two entries because the second entry may save you. And in this case, the second entry definitely saves us because price comes down and, you know, the rest is history in terms of how many pips we're able to catch from this. But just to go back to understanding this now, okay, we're going to mark out another session candle. Let's find one. There is going to be one more session candle in here somewhere. Okay, here. This one here is a London session candle, okay? Now, with this being a London session candle right here, what happens here, okay? We're going to mark out from the close of the bearish candle. We can see price pushes up 23 pips and price comes down 24 pips, okay? Price is pushed up over here 43 pips, okay? It's pushed up here 43 pips. As we can see, 42, sorry. This is above the criteria that's required for us to be interested in taking a trade. But what we have to understand now is, well, because price is so close to the top of this London session candle, we're not going to take an entry off of the top, because if we took an entry off of the top here, this wouldn't really be considered a sufficient pullback. Price is pushed up here. If it came there, I wouldn't be expecting price to turn around and do that. I'd want price to give me a proper pullback. So in actual fact, in this instance, we wouldn't be able to catch the trade off of the head of the candle. We'd only be able to catch the trade off of the 50%. And this is why the 50% is really important, because the 50% can sometimes give you a better understanding when it comes to taking a trade deeper inside of a candle, which can, you know, in this case, make you more profitable, right? So we catch this trade and we take a buy from here, okay? 35 pips is where? 35 pips is here, okay? And if I just make this one a bit smaller, okay, let's move it over here. Price pushes up and it gives us 64 pips. So it's 6 pips short of our second take profit, but we still net 1%. Now, this is the perfect example to let you guys understand, because we know the market has failed to make a new high, okay, this to us indicates that the direction is probably going to change. Therefore, you have to make a decision to understand that your trade is going to be a short-term trade. Okay, if you can see the market is making lower lows and lower highs and there's liquidity below for the market to come down, then any buy I now get into whilst the market is coming down has to be a short-term buy. And if that's going to be a short-term buy, the question you should then ask yourself is, hey, maybe, just maybe, I should reduce my stop loss if it's possible, because if I'm risking 20 pips as a SL, that's my 1%, right? Which would then mean if I'm up 20 pips, I'm up 1%. If I'm up 40 pips, I'm up 2%. In this case, price goes up to 64 pips, which would mean we could catch a 6%, we could catch a 3% here off of this trade. So we have to understand and make that decision to say, hey, price is most likely coming down. Any trade I get into from here is going to be a short-term trade. So let me not, set and forget the trade. Let me not set this trade and go away and come back and expect this trade to have done amazing, because really and truly, remember guys, if we take ourselves back to where we was right here, okay, there's two things that's happened inside of this area right here. The first thing that's happened, guys, is this. Price moved down more than 40 pips, right, over here, yeah? So by the time price came back up, it touched the foot of this London session candle, or this New York session candle, sorry. It touched the foot right here. That wick right there would have triggered you into a sell. It would have triggered you into a sell. Okay, we later on could see that price pushed up a bit more higher, so we would have taken another trade off of the 50%. However, our criteria was also met to get into a buy. So now we have to think to ourselves, well, which one's going to be more favorable? Which one do I favor more? Based off of what I can see here, price has been Based off of what I can see, price has been riding high for a considerable amount of time. So because I can see price has been raging higher and higher and higher and higher and higher, there has to come a moment where I say, hey, maybe the liquidity below is going to be the target, okay? And what we see happening here, if we play this out a bit slowly, we see price comes down and it plays into this candle, which triggers you into getting into a buy, guys. You just have to understand the significance of how strong you think this buy is. And in this case, not very strong. It's a short-term trade, okay? Because you're still waiting for price to push up, or really and truly, because you've got into the sell, you're kind of in a risk-free situation. Some would call this hedging, but you're not necessarily hedging because one trade serves a shorter purpose than the other. And right now, in this moment, you don't know which one that is. That could be either your sell, that could serve a short-term purpose, or it could be a buy that serves a short-term purpose. Of course, we've seen here, price has come down. It's closed beneath its lows in here. So based on us seeing price closing beneath the low, the structure has changed from bullish to bearish. Now that it's changed and we're seeing price aggressively pushing higher, hey, price has made a new high right here. But this is the question we ask ourselves. Has price made a new high, or has price just gone up to grab the liquidity? Now, based off of that, once we see price playing out here, what we see happening is price is consolidating to eventually it starts to drop, right? And, you know, it doesn't really matter about the rest of it in terms of what we can see happening. But all we know is based off of this small price action that we're seeing taking place over here, price pushes up and it taps into your TP1, which means you should always be going break even, okay, which is risk free. You should always be going break even when price hits your 1% target, just so that you're avoiding any losses. If price pushes up and hits your second take profit target, or if it comes close to your second take profit target and it doesn't hit it, then that's just the name of the game. You have to make a decision to say, hey, do I want to remove some partials because I believe more in the sell, or do I sit and hold this trade and see how it plays out? Now, losses are going to come a part of this, guys. Losses are a part of the game. Snakes and ladders. Losses are a part of the game. The first entry we take, this sniper entry here, price comes down, okay? And when price comes down, let's move this out of the way. If we look here, I'm going to make a new one. In fact, I'm not even going to make one. We're just going to do this, okay? From this wick here, price comes down. It comes down here. And it gives you 41 pips, right? So that means when you got into this sell from here, your first take profit target was already smashed. So you should have already been risk-free. So that by the time price pushes up, you guys have been tapped out of the trade at break even, but you've already taken 1% off of this trade, right? You've been able to close some partial profit. So now price has come down. It's played deeper into your 50% where you should be taking the buy. A lot of the time I'm seeing questions from you guys who are saying, you know, I just don't believe price is going to do what it's going to do until it does it. That just says you don't believe in the setup. You guys have to believe in the setup. If you've marked out your criteria, okay, you have to shoot. You miss 100% of the chances you don't shoot. So the only thing really missing in your arsenal right now is you guys taking the actual shot. I've backtested this strategy. I've gone over 2 years worth of data, okay, on an hourly time frame. It's taking me over 8 hours in one sitting, guys, to literally go through the charts, go through 2 years on an hour time frame, replaying the feature to see exactly how profitable this strategy could be. And I'm telling you guys that it works. Not only does it work, but this strategy can be the only strategy you ever use for the rest of your life if you can control being patient. If you can control your discipline, this strategy really can be the one for you. So based off of what I'm saying to you here, guys, when price pushes up, we're in a buy, right? We're in a buy because, hey, price pushed up here. And when it came back down, we wasn't going to take a trade off of the head of the candle because it's too close. It's too close, okay? So we wait for price to drop deeper into the 50%, into the equilibrium where price drops into. We take a buy from here. And what happens? As we've already mentioned, price pushes up, gives you 63 pips. So it's already hit your first take profit target. And, you know, if you're risking 35 pips, then yeah, it hasn't hit your second take profit target, or it shouldn't have. Okay. If you're using your take profit targets as a percentage, so you're taking profit at 1%, 2%, maybe you're taking profit at 1.5%, 2%, 2.5%, 3%, who knows? Okay. But for me, my second TP wouldn't have been hit, but I wouldn't have taken a loss. Most of you guys would probably keep the trade open, not move your SL, and eventually price comes down, stops you out of the trade. This is the reason why you're not getting the best out of this strategy, because you're not putting yourself in a position where you're monitoring what's actually happening. Okay? Now, of course, we can lose the trades. I mean, let's do the maths here right now. Okay, if I lose 5 trades, okay, if I lose 5 trades, let's make it easier. If I lose 10 trades, yeah, 10 losing trades, right, at 35 pips a pop, that's 350. Okay, that is 350, right? But guys, if we now decide to win 10 trades, okay, so if we have 10 wins, right, 10 wins, that would give us 1,050. Okay, it's a bit messy there, you have to excuse me. 1,050. That is the amount of winning trades we have. That is the amount of winning trades we have based off of us having 10 winning trades. That's the amount of profit, excuse me. So if you then take away 350, you're still netting 700 pips, guys. So really and truly, we can understand that, hey, even if I win 5 trades, only 5, and I still lose 10, I'm still going to net 500 pips. Okay, let's do the maths on that and make sure I'm correct, because it's late in the day here in Dubai. I don't want to be lying to you guys. 105 times that by 5 is 525 to be exact. Take away 350, that leaves you with a net of 175. You're still netting 175 pips. You can lose 10 trades with this strategy, okay, win 5 and make back the 10 losses. It's impossible for you guys not to come out on top. You could lose 100 trades, okay, 100 trades, and get 50 trades right and still net. So you have to understand, guys, yes, sometimes you're going to take a trade based off of a session candle and you're going to lose the trade. But all you're doing is you're keeping yourself in the game for the next trade. Because when the next trade comes, there is a huge possibility that price can not only work in your favor, but can also give you more than 3% as well. And that is what you're in this trade for. That is what this strategy can do for you. When it's favorable and when it works, it can give you way more than 3%. There's times where I've shown you guys we've received 9%, we've received 10%. Sometimes you can receive a lot more, but you have to stay patient. That being said, let me know what you guys think in the comments. Any thoughts, any questions? Of course, I do have a community, which I welcome you guys to join. All you have to do is click the link in my bio, and I'll see you guys on the other side. Money day.